markets expect that if there's any trouble, the Fed and other central banks will step in and create all that central bank money, which is called reserves, out of thin air to save everyone again. So that's why I think gold has made an all-time high. And silver, in my opinion, is a steal and is probably ready to break out very soon. But the bullion banks and the bankers are trying to desperately to keep it below $26, which I think is a key level.
In a study analyzing 50 years of data, the World Gold Council found that gold returned 15% per year on average during periods when inflation exceeded 3%. In contrast, gold returned just 6% annually when inflation was under 3%. This demonstrates gold's tendency to outperform when inflation is elevated. MarioInnecco is a seasoned financial market analyst, renowned for his deep insights into navigating the complexities of the global financial system. In this video, MarioInnecco contends that inflation stems from currency and credit expansion due to growing national debt and deficit spending, underscoring central banks' inefficacy. In his assessment, Mario highlights the record-breaking surge in gold prices and suggests that silver's undervaluation presents an opportunity for a significant breakout. Historically, gold and silver have seen significant price increases during inflationary periods. For instance, during the inflationary years of the late 1970s, gold prices skyrocketed. Similarly, silver prices followed suit when inflation surged in the early 1980s. This pattern is not coincidental. These precious metals are known as inflation hedges for a reason. They have an intrinsic value that doesn't erode in the face of inflation. Moving forward, Mario cites gold. We trust data since 2000, showing that the currency supply has grown faster than gold, indicating the real inflation rate. Innecco refers to gold. We trust data since 2000, showing a 9.3% increase in dollars and over 10% in pounds, indicating how currency is outpacing gold supply, revealing the real inflation rate. Now, we present the clips of MarioInnecco's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Right now, I think the majority of the mainstream media, the majority of the public still buy into this narrative that the central banks have done a good job in controlling inflation. They've brought it down and everything is fine now. But the way I see it, they don't really look at the real inflation, which is the increase in the amount of currency and credit out there, which is the other side of the coin of the national debt and all the deficit spending. And that's why I think markets are reacting as they are. And markets expect that if there's any trouble, the Fed and other central banks will step in and create all that central bank money, which is called reserves, out of thin air to save everyone again. So that's why I think gold has made an all-time high. And silver, in my opinion, is a steal and is probably ready to break out very soon. But the bullion banks and the bankers are trying to desperately to keep it below $26, which I think is a key level. The problem with inflation and how it's defined today is that they define it as the price rises, which is not really inflation. Inflation is the increase in the supply of money and credit, or currency and credit. The way, if you look back prior to fiat currency regime, the supply of currency and credit depend on how much gold you had in the system. So if you look at In Gold We Trust, Incrementum, they keep the scorecard of gold in all major currencies since the year 2000. And gold has averaged, I think in dollars, has gone up 9.3% per annum on average since the year 2000. In pounds, it's just above 10. So I would say that's the real rate of inflation, because it's telling me that the supply of currency is increasing about 10% more than the supply of gold out there. So that's the true true inflation, and that's why people always complain. They say, "Oh, the CPI is bogus because things are going up a lot more." Well, there you go. That's because CPI is just like they have a they use hedonics. They say a car in 1990, let's say, it was $20,000. Now it's 60,000. They say, oh, because of all the improvements, that car is really only worth 20. So they don't put any of the increases onto the CPI. But you can't go to a car dealership and say, I want to buy the hedonic. I want to pay the hedonically adjusted price. He'll laugh at you, right?
Cocoa futures have surged this year, roughly doubling since the start of 2024. Rising temperatures and weather conditions have stressed and damaged West African crops, producing more than 70% of the global cocoa supply. Drawing a comparison between silver and cocoa, Mario anticipates a significant surge in silver prices, potentially triple gains. He proposes that if silver overcomes crucial resistance levels, it could soon surpass the $50 mark. Since reaching an all-time high of $49.51 per troy ounce in April 2011, silver has continued to fall, struggling to recoup even half of its gains. The highest price of white metal in recent years was during the COVID-19 pandemic, when it hit over $28 in May 2021. Currently, silver sentiment leans moderately bullish, but uncertainty persists. The bull case relies on steady economic expansion, rising technology use, and sustained investment interest supporting prices. Let's get back to the interview.
I mean, if gold was still languishing around 1900 or 2000, I probably wouldn't have read much into that chart of cocoa, but I went back to the early 70s and with both cocoa and silver, and their charts look very similar except for the move higher in 2011, where cocoa didn't really match its high from 1980 or the early 70s. They look like a huge cup and handle, and the handle that we've been forming in silver since, let's say, 2020, 2021, we're still within that like handle triangle. And cocoa had the same kind of formation, and it broke out of that triangle last year, and it's taken a few months, but it's gone from around $2,500 to $3,000 a ton. And I think the last I saw this morning was above $8,000. So it's a massive, like 3.5 times. So if you translate that to silver, and if we break like 26, 25, we could see silver easily above 50 in the next few months. I'm not saying it's going to happen right away, because if you look at the monthly cocoa chart, it's taken a while for it to do what it's done. But in the last month or so, it's really gone. I think the biggest risk really is the collapse of all the currencies, because that's what a melt up points to. The stock market, I could, not care less, but I think it's irrelevant, because if they lose control of the currency, and by that I mean if gold goes parabolic, it doesn't matter if the Dow is at 100,000 or the S&P is at 20,000. While gold is at unimaginable levels. So I think the biggest risk is not really a crash of the stock market, but a crash of the currencies. And I think very few people see that, because they're so focused on the stock market. And maybe the reason I see it is because I'm not in the US. I grew up in Brazil, and currencies are really important to other people around the world, because Americans have never had to worry about currency. As the former Secretary of the Treasury, John Connolly, said to a European official, yes, the dollar is our currency, but it's your problem. So I think it's going to flip. And that's why I think the biggest risk is not just the dollar that's could completely collapse. It's all other fiat currencies. So if you're thinking that you can hedge collapse of the dollar by buying euro or Swiss franc or pounds, I think you're going to be wrong. So that is, I think, the biggest risk. I wouldn't be. I think if you've got some gold and you've got stock market investment, yeah, you just hold on to it, because I don't think the central banks are going to allow the stock market to crash. They're just going to keep pumping it up, and that's going to accentuate this melt up.
The most recent inflation report, issued in January, showed that the inflation rate is at 3.1%, which is still higher than the Federal Reserve's target goal of 2%. This may also help drive the uptick in gold prices. Furthermore, with ongoing uncertainties surrounding global economic stability and central bank policies, the stage for continued upward momentum in gold prices is set. Will gold and silver fulfill their roles as reliable inflation hedges, or will other factors intervene to shape their trajectory in the coming months? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.